Chapter 10, How to Leave a Large Tax-Free Inheritance Without Life Insurance. It is my opinion that the Roth IRA is the most effective and underutilized method of transferring wealth to future generations. Now, I can hear all the life insurance agents out there screaming, Roth is not preferable to life insurance, Josh. And to my life insurance friends, in some ways, I agree. There is no other method where one could create an instant estate as quickly as life insurance. Only life insurance can create an instant estate. For instance, say you're 45 years old, making good money and in good health. Your net worth consists of the equity in your home and $250,000 in retirement savings. One day you get hit by a bus and die. Your spouse will inherit your equity in your home plus your $250,000 in retirement savings, assuming the house was jointly owned and he or she was a beneficiary on the retirement account. While that's a decent amount of wealth, it isn't generational wealth by any stretch. And of course, at some point, your spouse will be forced to pay taxes on the retirement account, thus reducing its value. However, for pennies on the dollar, you could buy a $2 million life insurance policy, but there's a couple problems with this scenario. The most obvious, of course, is that you had to die for that sizable estate to be created. Maybe not a big deal if you're in your late 80s and have major health issues, but for a 45-year-old with kids, you probably want to avoid that. The second issue is that you have to pay for the life insurance premiums until you die, and who knows when that will be. So your premium payments continue for many, many years to come. The vast majority of life insurance never actually pay out. Most people stop paying the premiums well before they die. But what if you commit to paying premiums in order to have a policy pay out at your death? Well, you still have to get underwritten for the policy. The older you are, the more difficult it will be to get approved. And of course, the more expensive the insurance will be. When you're young and in good health, life insurance is easy to get and cheap too. But while policy on a 45-year-old woman who is in good health will not be very expensive, is multi-generational wealth creation something that is of foremost importance to her? Especially if she's a divorced working mom with children to raise, college costs to consider, and her own retirement to save for. I highly suspect it's not. So while I do love life insurance and believe everyone should get a term policy when they're young, it is absolutely not superior to a Roth for multi-generational wealth planning. Imagine if the Roth IRA existed in 1972. Say you're in sales, going to door selling encyclopedias. Your efforts paid off when you stumbled onto a neighborhood with a large number of buyers who really liked the idea of having all that information at their fingertips. You had a great year in 1972, your best year ever, in fact. So you decided to invest $5,000 of your after-tax commissions into this account called a Roth IRA. Unfortunately, in the first 2 years after you made that initial investment, the markets fell 14% in 1973 and 26% in 1974. So your $5,000 initial investment fell to $3,186 by the start of 1975. You had discipline, though, and just let it sit there. Easy come, easy go, you said to yourself. Then the magic of compounding interest began to work. Even with the massive crashes of 73 and 74, you averaged 10% a year over the next 3 decades. Since this account was a Roth IRA, there is never, ever any required minimum distributions, and so you never touch the account. Just let it grow. Unfortunately, in 2006, you got hit by a bus and went to your greater reward. But before you left this earth, with your last breath, you asked your wife, please, honey, don't touch that Roth IRA we started back in 72. Just let it sit there for the kids. October 2007 came around and times got scary with investments. By March of 2009, the inheritance was cut in half. Your wife said, maybe it's time to get out of the market just to protect what we had left. But after some thought, though, she said, well, it's gone down so far, might as well just let it ride. And after all, we only started with $5,000. And she just did that. She let it ride. In January 2018, your wife got hit by that same daggum bus driver and joined you in paradise. But before she took her last breath, she looked at the Roth statement one last time. She was amazed. The $5,000 you put into it back in 1972 was now worth $364,000 tax-free. Hundreds of thousands of tax-free dollars were created from a tiny $5,000 investment. Far-fetched? Nope. These are actual real-world numbers starting during the market crash of 73 and 74. This multi-generational wealth planning is within your grasp if you are disciplined enough to reach it.